Welcome to Talk Tickers. Today is Saturday, January 17th, 2026.
It's great to be here.
We are, I think it's fair to say, sitting in the eye of a structural hurricane. It's happening in, the world's most important market.
Absolutely. And the first part of it has already happened. Phase one of the SEC's Treasury clearing mandate, the part for cash transactions, that went live just 2 weeks ago, December 31st, 2025.
That's right. The first shoe dropped. But the real earthquake, that's still 6 months away, isn't it?
It is. The big one is June 30, 2026. That's the deadline for clearing repurchase agreements, repo.
Exactly. And this is the change, the real plumbing change, that threatens to completely upend the basis trade.
And, for anyone listening who thinks basis trade just sounds like some Wall Street jargon,
yeah,
we need to be clear. We're talking about a massive arbitrage strategy. It provides absolutely critical liquidity to the U.S. government bond market.
It's the grease in the gears.
It really is. The grease in the gears of the whole global economy.
So that's our mission for this deep dive. We're going to try and strip away all the regulatory noise and just look at the raw mechanics. How is leverage changing? Why is this idea of zero haircut financing basically dying?
And what happens to Treasury liquidity when the cost of being one of these arbitrageurs just spikes?
It's one of those topics where you really have to get into the technical details to see the full story. This isn't just a rule change.
No, it's like we're changing the fundamental physics of how U.S. debt is traded.
Okay, so let's start with a snapshot. A high-level view of where we are right now. What is the mandate, exactly?
Simply put, the SEC's rule says direct participants have to clear their eligible secondary market trades through a covered clearing agency.
In English?
In English, it means trades that used to be private, between two parties, now have to be forced through a central clearinghouse, a middleman.
Okay, let's unpack that timeline because we're in this sort of limbo period right now. Phase one is done.
It's done. As of 2 weeks ago, any intradealer brokers, registered broker-dealers, they have to clear their cash buys and sells of US Treasuries.
So the straightforward stuff, buying and selling bonds.
Correct. The cash side. And to be fair, that transition, it seems to have gone relatively smoothly. So far, at least.
But the bigger beast is phase two, June 30th. All repo and reverse repo agreements. They all have to be cleared.
And the scale here is just staggering. You're talking about a market with over $6 trillion in daily activity.
That's incredible. And before this, most of that, especially the repo part, was what they call NCCB.
Non-centrally cleared bilateral.
Right.
Which is really just a fancy way of saying handshake deals. It was, a bank and a hedge fund. They'd agree to terms between themselves. No middleman guaranteeing the trade.
So the disruption is that shift from that private bilateral world to one where everything goes through the FICC, the Fixed Income Clearing Corporation.
And that's the key. That introduces mandatory margin requirements.
Which brings us to the very heart of the issue, because to understand why margin is such a big deal, you have to go back and look at the history of this basis trade and the dash for cash.
Exactly. We have to define the trade itself. We hear Treasury cash futures basis trade all the time. So how does it actually work?
Let's break it down.
Okay, so it starts with the big asset managers. Think pension funds, insurance companies. They have this structural need for duration. They have to hedge their long-term liabilities.
So they buy Treasury futures. It's more capital efficient than buying the bonds outright.
It's much more capital efficient. But that huge demand, it pushes the price of the futures contract higher than the price of the actual physical cash bond.
And that little gap, that price difference, that's the basis.
That's the inefficiency. That's the opportunity.
Yeah.
So the hedge funds step in. They are the arbitrageurs here. They sell the expensive futures, so they go short.
And they buy the cheap cash treasuries. They go long.
Exactly. And they're betting that at delivery, those two prices will converge and they'll pocket the difference.
It sounds like a sure thing, almost a risk-free trade.
In theory, yeah. But here's the catch. The spread, the profit on that trade, it's tiny. We are talking basis points, fractions of a penny.
So to make any real money, you need massive volume.
Massive. And to get that volume, you need leverage. Huge leverage.
I've seen reports of funds running this at 50 to 1. Maybe even higher.
Oh, easily. And the fuel for that leverage is the repo market. They take the cash treasuries they just bought, use them as collateral to borrow more cash.
To buy more treasuries. It's a loop.
It's a loop. And this is where it gets really interesting, especially how it worked in that old bilateral world. The secret sauce, if you want to call it that.
The zero haircut.
The zero haircut.
Explain that, because normally when you get a loan, you have to put some cash down, some collateral margin.
Not here. In the old bilateral market, studies show that over 70% of Treasury repo volume happened at a zero haircut. So if a hedge fund had, say, $100 million of treasuries, a dealer would lend them $100 million in cash against it.
So they didn't have to put up any of their own equity capital.
Practically none.
Yeah.
It let them borrow 100% of the value. That's what made the trade work. Your return on equity was essentially infinite. It made those tiny little spreads massively profitable.
But then March 2020 happened.
The trigger. COVID hits. Volatility goes through the roof. The margins on the future side, at the exchange, they shoot up. Suddenly hedge funds are facing these huge margin calls.
And they'd all have to unwind these massively leveraged positions at the same time.
Which creates a fire sale, a liquidity spiral. The market just froze. The Fed had to step in with trillions of dollars just to keep things functioning.
So if you're looking for the why behind this SEC mandate we're living through, that's it. It's March 2020. The goal is to reduce that counterparty risk, increase transparency.
By forcing it all into a central clearinghouse.
Which sounds good for stability. I mean, we all want a stable market, but now we have to look at the mechanics of this new regime, because when you move to the FICC, that zero haircut becomes a math problem.
A huge one. The central counterparty, the FICC, their whole job is to manage risk. And they do that by collecting margin. They don't care about your relationship with the client.
There are no handshake deals.
None. So even if a dealer wanted to offer a client a 0% haircut, the dealer themselves has to post margin to the FICC on that trade.
So that cost has to be passed on.
It has to be. Either the client pays for it or the dealer eats it.
Yeah.
Either way, the cost of the trade goes up. You're moving from a world of what felt like free leverage to a world of explicitly priced leverage.
Okay, this brings us to the big hope for the industry, which is netting and cross-margining. This is the solution everyone is talking about, right?
It is, and the concept makes a lot of sense. If a fund is long cash in their repo account and they're short futures at the exchange, let's say the CME.
Those are offsetting risks.
They're offsetting risks. If rates go up, you lose money on your bond, but you make money on your short futures position.
Yeah.
So ideally, the margin should net out. You shouldn't have to pay twice.
Right. That makes total sense.
Ideally. But the reality is what some are calling the double margin trap. Without really efficient cross-margining agreements between the clearinghouses, between FICC and CME, a fund has to post margin to FICC for the repo, and they have to post margin to CME for the futures.
That would just destroy the capital efficiency of the trade. That 50-to-1 leverage, it becomes completely impossible.
Completely. And look, there are proposals out there for cross-margining, but actually executing that across different clearinghouses with different risk models, it's incredibly complex.
It's like trying to get Apple and Android to run the same operating system perfectly.
That's a great analogy. It's really, really hard to do.
So you've got this trade that needs high leverage, but the new rules make that leverage really expensive. We should also touch on how these funds even access the clearinghouse, because most hedge funds are not direct members of the FICC.
No, they're not. The membership requirements are pretty steep, so they have to go through an intermediary, a bank. And there are two main models here, the sponsored model and the agent model.
The sponsored model is the simpler one, right? The done-with trade.
Generally, yeah. The dealer, who is a sponsoring member, basically handles the clearing for the client. The dealer guarantees the trade to the CCP. It's a package deal. You trade with me, you clear with me.
That sounds convenient, at least for the hedge fund.
It's convenient, absolutely. But it eats up the dealer's balance sheet capacity. The dealer's on the hook for that trade.
Okay, but then there's this agent model. This is where it gets more technically interesting.
This is where the dealer just acts as an agent, and the client, the hedge fund, faces the CCP directly. This is a huge deal because of the accounting.
Right, because if the dealer is just an agent, the trade doesn't have to sit on their balance sheet.
And that matters for the SLR, the supplementary leverage ratio.
The big constraint on bank lending.
It's huge. If banks can use this agent model to keep these trades off their balance sheets, it means they have more capacity to intermediate for clients.
So why isn't everyone just rushing to do that?
Because it puts all the operational work on the client. The hedge fund has to build out its own infrastructure to manage intraday margin calls directly with the clearinghouse. It's a much heavier lift.
So it's a trade-off, ease of use with the sponsored model versus balance sheet efficiency with the agent model.
Exactly. And right now, it feels a bit like a staring contest between the banks and the funds over who is going to adopt what and who is going to bear the cost. Let's
shift to the investor context then. Looking ahead to the rest of 2026, Phase 2 goes live in June. What does this mean for the broader market? I mean, why should our listener, who probably doesn't run a hedge fund, care about any of this?
I think the number one concern is a potential liquidity gap. You have to ask who buys the off-the-run treasuries.
These are the older bonds, not the brand new ones.
Exactly. And historically, hedge funds have acted as the warehouse for those bonds. They buy them, they hedge them with futures, they hold them.
But if the basis trade becomes less profitable because of these new margin costs,
they'll stop doing it, or they'll do a lot less of it. And if the hedge funds pull back, who steps in to buy all those off-the-run bonds? The risk is you see much wider bid-ask spreads. It just becomes more expensive for everyone to trade U.S. debt.
And if trading U.S. debt gets more expensive, that inefficiency will trickle down into every other asset class.
It has to. Then there's the other issue, which is market concentration.
The fact that FICC is basically the only game in town.
For now, yes. So we're moving from a world where you could have a bilateral blowup, which is messy, but kind of isolated, to a world with a single point of failure.
So if FICC has a problem, the entire market has a problem.
The entire market has a problem. It's the too big to fail issue, but now it's concentrated in the plumbing itself.
Yeah.
And while, CME and IEC have applied to clear treasuries, for now, that concentration risk is very real.
I want to go back to balance sheet capacity for a second. The argument from dealers has been that central clearing creates balance sheet netting, which should free up capacity for them. But some of the research says maybe not so much.
That was a really interesting point from some Fed research. It basically found that the big dealers were already doing a lot of this netting bilaterally. They were already structuring their trades to offset risks on their own books before this rule came along.
So they were already being efficient.
Pretty efficient, yeah. So the move to central clearing might not be this silver bullet that magically unlocks a ton of new dealer capacity to absorb all the treasury issuance.
We shouldn't expect a sudden flood of liquidity just because of netting.
I wouldn't. Now, that said, there was some helpful guidance in late 2025 about the agent model. It confirmed that in that specific setup, dealers don't have to hold a customer's trade on their balance sheet. That is a bullish signal for bank capacity, but again,
it all depends on whether the hedge funds are willing to sign up for the operational headache of agent clearing.
It all comes back to that. It's a game of chicken. The regulators want safety, the banks want balance sheet relief, and the hedge funds just want their cheap leverage back.
And meanwhile, the US Treasury needs someone to buy all the debt it's issuing.
That's the other side of it. The supply of treasuries is not shrinking.
Which really brings us down to, I think, the one question. If you're watching this whole situation unfold, what is the single most important question you should be asking yourself?
The question is this: does the cost of mandatory margin exceed the spread available in the basis trade?
Break that down for us. Why is that the absolute tipping point?
Because if the cost of your capital, the margin you have to post, is higher than the profit you can make from the arbitrage, the basis trade just evaporates. It's simple math.
And if that trade evaporates,
you are removing the largest, most consistent source of buying power for U.S. debt other than the Federal Reserve itself.
That is a very sobering thought. We are effectively running a live stress test on the price sensitivity of the plumbing of the global financial system.
We are, and we're not going to know the final answer until after June.
So to wrap this all up, we're in this major transition. Phase 1 is live, phase 2 is looming in June. We're moving from this high leverage, opaque, bilateral market
to a transparent, margin-intensive, centrally cleared market. The stated goal is financial stability. It's about preventing another March 2020.
But the potential cost is a permanently more expensive and possibly less liquid market for U.S. government debt.
You're essentially buying insurance against a systemic crash. But the premium on that insurance policy is liquidity.
That is the perfect way to put it.
And we're about to find out just how high that premium is.
Definitely something to watch closely as we head into the summer. This has been Talk Tickers. Stay informed.